Property investors, in this video I'm going to show you how to complete a property revaluation in Xero. Okay, firstly then, why do you need to complete property revaluations? If you have a property investment company, then you're going to have to complete end of year statutory accounts and submit them to HMRC into Companies House. There's two primary types of accounts which you may need to submit as a property investment company. Okay, the first one is you could submit accounts as a micro entity. That's if you have a turnover of less than £632,000, you have £316,000 or less on your balance sheet, you have 10 employees or less. Second type then is as a small company. Small companies consist of the following attributes: to have a turnover of less than £10.2 million, they need to have 5.1 million or less in their balance sheet, you have to have 50 employees or less. Micro companies and small companies have different reporting standards that they need to make. There's a number of differences between the reporting requirements for micro companies and small companies, but probably the most important for property investors is how they account for property investments. So firstly, with a micro company then, essentially the value of that property remains the same. It's put on the balance sheet at the cost you spend for it, because that's the amount of money you pay for it, so that's the purchasing cost plus any capital costs. Then essentially it will stay that value throughout, and you'll have to look at depreciating the asset as well. With a small company though, it's slightly different. So the property investment is firstly put onto the balance sheet at cost. So again, that's at the purchase price plus any capital expenditure to purchase the property. However, rather than with a micro entity just being held the same value throughout as the years go on by, every year as a small company, the directors have to assess the fair value of the investment properties and potentially conduct revalue the assets upwards or downwards depending on the property market at the time. Noting that most property investors get into the game of property investment to benefit from capital appreciation from their investment properties, clearly see how reporting as a micro entity might not be appropriate. The reason is, for property investment companies, there's going to be a lot of activity in the balance sheet as property values increase over time, and therefore even though you may meet the requirements of a micro entity, it could make sense to report still as a small company. This is something you should discuss with your accountant, but just bear in mind that for a property investment company, realistically the value of your properties are going to increase over time, and a small company reporting regime is going to enable you to capture that in the balance sheet of your investment company. Okay, one example of where this might be important is if you're looking to raise finance against your property portfolio. If you're reporting to mortgage lenders that your property value of your property portfolio is at a certain amount, but then you're using micro company reporting and actually the balance as per the balance sheet is lower than that, then there could be an issue with raising finance. It usually makes sense to report as a small company rather than a micro company for that reason. What we're going to do now is I'm going to show you a demonstration as how, if you're a Xero user, how you can go into that software and you can raise the value of your properties accordingly at year end. Watch in for a demonstration now. Okay, I'm now going to show you how to do the property revaluations in Xero. So from the dashboard screen then, we're going to click on accounting and then click to balance sheet. Once we're in the balance sheet then, you'll see at the top I have a different accounting code for every single investment property. I've got a separate video which I'll link, which will enable you just to do this yourself. I'll show you how to set up a separate accounting code for each investment property. You can see at the bottom there we've got new house investment properties. So that's a made up one we're going to use today for an example. So you can see it's valued at £100,000. For the example, let's say we've conducted our fair value assessment at year end. Let's say the year end is 24th of February 2024. It's not, in fact, that is today's date, but just for the sake of simplicity, let's say it's the year end. And so if you did have a different year end, I would suggest that when you do this, you click, you change the date to the end of your last reporting period, because that's when you're going to conduct your property revaluations as at. Okay, so see that it's £100,000. We've done a fair value assessment and we now think it's worth £120,000. So this is how we then go to conduct that revaluation. So we're going to scroll to the top and we're going to click accounting, scroll right down to the bottom, manual journals. Then we're going to click new journal. From there, then we're going to enter a title for it. So let's call it end of period fair value adjustment. Then we're going to put the date in. So this would normally be the last day of your reporting period, but in this case I'm going to use today's date. But when you're doing it, make this the last date of the end of your reporting period. We're going to do then is we're going to click on description for 2 cells, and that's going to basically copy down the narration into them to help us track the transaction. There's 2 counts we need to use primarily initially. So the first one is to revalue the asset in the balance sheet. So we're going to find the specific accounting code for the property in question. So it is new house investment property. So this would be a different accounting code for your individual property, and as discussed, have a separate accounting code for each property. We're then going to click, for the second one, we're going to use property revaluation of property. This is the second part of the transaction, which is basically to increase, to show in the profit and loss the increase of the value of the property. So in traditional accounting, there's basically every transaction has 2 parts to it. You've got the first part, which is going to go in the balance sheet, and the second part in the profit and loss account. So next we could click here. If we set up tracking categories, we could include that there. I'm not going to use that in this demonstration, but that's a way that you can track, to help you track different activity for different properties. I've got a separate video to talk about tracking categories. So as discussed, there's 2 parts to this transaction. There's firstly the debit amount, which is going to be to increase the asset in the balance sheet. So we said the balances, the property value has gone up by £20,000, so we're going to put £20,000 here. This corresponding credit then, as per traditional accounting, is going to go as a credit, and that's for the revaluation of the property. So that's going to show income of £20,000, which is essentially an unrealised gain in the accounts, because you haven't actually sold that property yet, but we have to track it as income. Even though we're not going to pay tax on that now, we could do it in the future though when we come to sell that property. So we're going to put £20,000 in there. See there at the bottom then both the debits and the credits balanced £20,000 in each, so that's going to work then if we click post. I haven't discussed this here. I think it probably deserves its own video in its own right, but if we're going to be revaluating our properties, we have to consider deferred taxation. So talked about the increase in £20,000 being an unrealised gain. Something in small company accounts that we have to track is deferred taxation. Again, I think it needs a separate video for this, but this is using this same transaction journal is where you could include the deferred taxation figure. So this is something, if you're going to be doing property revaluations, you'll need to speak to your accountant at year end to make sure they're tracking your deferred taxation. And I'll record a separate video to discuss this in more detail. Okay, so now we're happy with the journal, then we're going to click post. Okay, we're then going to check the transaction has been successful, so we're going to click on firstly back to accounting and then into the balance sheet. If we scroll down to our new house investment property, we can see that the value has now increased from £100,000 to £120,000. So that's correct. And we could conduct this same method for each of our other investment properties. That's going to have the same impact. The reason why I have a separate accounting code for each investment property, I just find it easier to track the amount of property revaluations and the deferred taxation against each property. Another way you could do this though is have just one accounting code for investment property and then use tracking categories, which I've got another separate video on. But for me, this is the best way of tracking the different property revaluations and also the capital cost, the capital expenditure for each property. So use accounting codes for tracking property revaluations, deferred taxation, and capital expenses for property. And then I use tracking categories for tracking the different revenue costs for each investment property. I have a separate accounting code for each property. So we can see then, that on the balance sheet that revaluation has taken place. It's now valued at £120,000. So now we need to check the corresponding credit transaction has worked within the profit and loss account. So we're going to click accounting and then profit and loss. So if we scroll down, we just need to make sure the dates are correct for this reporting period, which are in this case. If we scroll down, then we can see then towards the bottom, then we've got revaluation of property. So that's worked, and the corresponding transaction has resulted in income being put through the profit and loss account. So that's correct. We've got the asset increased in the balance sheet, and then the revenue in the profit and loss account. So the transaction has worked, and the property revaluation has now been completed. So now we would just repeat that for our other investment properties, and then the property revaluation stage of the accounts process is complete. Okay, so just to summarise then, so even though a number of your property investment company might meet the characteristics of a micro company, it could make more sense to actually report as a small company, because that's going to enable you to increase the value of your properties every year to ensure that your balance sheet shows a true and fair reflection of your property investment company. One thing to bear in mind is that if you do revalue your assets, then you need to consider deferred taxation. This is something you need to speak to your accountant about, and I'm going to record a video at a later stage where I talk about deferred taxation in more detail. So to conduct a property revaluation, then there's sort of two things you need to do. Firstly, go onto your balance sheet and make sure there's a separate accounting code for each of your investment properties. Conduct your fair assessment of the value of the property. You can do this two ways. Firstly, you could use the findings of a revaluation that you've paid for recently, perhaps to support financing. Or second way is you can conduct a fair value assessment of the value of the property, and this can be done by taking a look at comparable properties, close to yours, and see what they're fetching. But just make sure you have a conservative assessment of what the value of your property is. Once you've assessed the value of your property, you just need to go into Xero and complete a manual journal. And there's kind of two parts to the property revaluation. Firstly, then you need to revalue the asset in your journal in the balance sheet through use of a debit. And then secondly, then you need to account for the income you receive from the revaluation of the property, and that's completed in the profit and loss account through a credit. So it's basically it's a manual journal, and there's two parts to it. There's a debit to increase the value of the property in the balance sheet, and then there's a credit which will basically show an amount of income for the increase in value of the property. And you'll have to think about deferred taxation, which I'll record a separate video on. Once you've completed the journal, make sure you check the balance sheet to see that the value of the property has been increased, and then check the profit and loss account to see that you can see that the property revaluation has been accounted for there as well. I hope you found this video useful. If so, please remember to like and subscribe and for